very good afternoon to all of you. At the outset, I would like to thank WRC for giving me this privileged opportunity to come here and speak before all of you. I've taken a lot of sessions online for WRC, but this is my first offline physical session at the BKC campus. So far, I've been used to speaking at CPE seminars. So this is indeed a day to remember for me. Having said that, I have a daunting task. It's not just that I'm going to take the post-lunch session with the Amras Puri meal that all of us have just feasted on. It is also the last session, I believe, in the Relearn series. So while I have exchanged some notes with my previous speakers, I don't completely deny the possibility of a small overlap, and if that is the case, I just request all of you to give a patient hearing. All right, so before I go to the subject per se, let this be an interactive session. I greet all of you seniors in the profession, contemporaries, peers, and a lot of young faces as well. It is indeed great that all of you have invested your Saturday, your weekend in attending this session. So I'm sure let us all have a mutually enriching experience. Thank you. So the topics which were allotted to me are basically twofold. I have a dual session here which ideally should last up to 5:30. Let's see how it goes. First one is Finance Bill 25, wherein I am supposed to cover some key amendments related to TDS provisions, of course, and some penalty-related implications. And the second part is TDS in transition, wherein just maybe a comparative provisions of the Income Tax Act and the newly introduced Income Tax Bill. So my coverage for today is outlined thus, as you all can see. Before I just go and kind of start with the topic proper, I have a brief and a very basic timeline drawn for how TDS has evolved over the number of years that are there, right? What started it exactly. Then we'll go on to some of the amendments. I'm sure some are covered in the earlier sessions. We'll not spend too much time on the ones which are covered. We'll go to some provisions which have changed in the penalty related provisions. Of course, again, from the perspective of TDS. Some Finance Act 24 amendments to put things into context. Lastly, we'll have some TDS in transition, some slides on the comparative of a couple of sections. And then I have some use cases and some examples on 194O and 194R, which is parked at the end of the presentation, depending upon the time that is available to us. So, TDS has actually been an untouched chapter for a very long time, right? And I say this every time I speak on TDS because when I was studying tax or when I was teaching it, rarely were there any amendments which took place in chapter 17B. We studied the same exemptions or the same rates, thresholds, etc. for quite a considerable period of time. Then suddenly, let us say from 2018, 2019 onwards, we saw 194M, 194N, right? We saw 206C. So somehow from 2017 or so, Chapter 17B gained momentum and we have thereafter been witnessing some or the other hustle in this entire chapter. But TDS provisions, the older ones that they were, have been on the statute for a considerable amount of time, right? Right from the inception of the Act, they were borrowed from the 1922 Act is what literature on it tells me. And the earliest introduction that I remember was in the year 1972 when section 194C, which is TDS on contractors, was introduced. And that time the rationale for introducing the section was that infrastructure or works contract or contractor related payments were a very big source where the government was foreseeing loss of revenue or a steady collection of taxes or a tax evasion. So possibly to contain all of that, they came out with 194C way back in 1972, where I wasn't even born, right? So it's like that older section. And gradually after that, TDS provisions started to take shape in the form of commission and brokerage, which is H in 1991, TDS on rent, which is 194I in 94. 194J was introduced in 1995, and I was in school that time, and I remember a lot of activity in my office. So my parents are chartered accountants. That time this section had newly come in. There was some circular, and there was a lot of activity as to what is to be done, how it is to be done. And now it is so easy, right? You have a digital mechanism for everything. But back then, those days, I believe it was very difficult to comply with these provisions as well. So given this journey in 2002, when the digital evolution, I can say, in form of traces or the tax information network started taking shape, that is where the TDS compliance and TDS provisions as a whole were simplified. So that is where actually implementing those provisions and adhering to them started becoming easier. And after that, where we are today, we have seen TDS related provisions to grow, as is the growth in the economy and the commerce sector around us. So e-commerce picked up, we had section 194O coming into place. You had all the rummy circles and all the online gaming platforms which came in. You had 194BA come in. So at this point, I think the government has somewhere been matching the speed of evolution in the economy by making this entire chapter robust to take care of different developments that this chapter has brought about in the last, let us say, 7 to 8 years, if not before that. So this is just a brief timeline for how the TDS related provisions have evolved over time. So this is again, yes, 194C to e-commerce 194A, and now we have traces form 26AS, which gives you all the information at the click of a mouse. Now moving on to the first topic that is supposed to be taken for the day are the list of amendments. I believe these were covered partially in yesterday's second session, that is how I have understood, but nonetheless we'll just quickly run through them. The implications of some of these amendments I have covered in these slides later on. This is just like a bird's eye view of what has changed. So both in 24 and 25, there have been a lot of amendments under the guise of rationalization of amendments or rates or thresholds. So Finance Act 24 with effect from 1st October 24 caused a lot of TDS rates to be sloshed down. There were reduction in rates, right? Likewise, in 25, there was an increase in the threshold for non-deduction of tax. So the legislative intent, if I look at the combined effect of both these set of amendments, seems to provide the taxpayer with some more liquidity, wherein on one hand you're reducing the rates and on the second hand you're increasing the thresholds. Though I have a couple of questions around that, we'll come to it later. So section 193, interest on securities, there was no threshold earlier, now it is set at 10,000 rupees. For dividend, it has been raised from 5,000 to 10,000. I'm not really going to read each of the line items here. Interest on securities, 1 lakh for senior citizen, 50,000 where the limit was earlier 40, and 10,000 where the limit was earlier 5,000 is the increase. Now in respect of two casual income sections that we have, which is 194B, that is winning from crossword puzzles, and 194BB, which is winning from horse races. While there has been no change in the threshold or any rate reduction this time around, what they have done is they have omitted the words or the aggregate of amounts during a financial year, and in respect of that they have inserted the words in respect of a single transaction. The implication being that any kind of casual income or windfall game in the nature of winning from lottery or crossword puzzle is now to be taxed on a transaction basis rather than aggregating whatever was earned by the taxpayer in the frame of one financial year. How this affects us, we'll look at a small perspective in the coming slides. Insurance commission, again from 15,000, the threshold has been raised to 20,000. 194G, which is commission on sale of lottery tickets, again the threshold is raised from 15,000 to 20,000. These amendments are taking effect from 1st of April 25, right? Commission or brokerage, again from 15 to 20. 194I, rent. I have an interesting details to share here in the next slides. So here the threshold earlier was for the entire year, which said that it was 2,40,000. So wherein your TDS did not exceed an amount of 2,40,000, there was no TDS warranted. Now they have tweaked the threshold to say that if the rent for a month or a part of the month does not exceed 50,000, then you need not do TDS. There's a slight anomaly here if some of you paid attention to the budget speech and you read to the finance bill fine print. We'll come to it in the coming slides. 194K income in units, again from 5,000 they have raised the threshold to 10. Payment in respect of compensation for some immovable property from 2.5, they have raised the threshold substantially to 5 lakhs. Now income in respect of investment in securitization trust. Insofar as earlier period was concerned, there were different rates where the recipient was an individual or HUF or any other person. There was 2% and 10%, 5%, different rates were there. Now they have given a singular rate of 10% in respect of this income. 206 AB, which was higher TDS for non-filers of return of income, the section is now omitted. Likewise, 206C1H, which was TCS on sale of goods, which caused a lot of hustle when it came in 2020, right, clashing with the pandemic year. It has been given a sunset clause from 1st of April 25. Consequential amendment in 194Q, where the reference to 206C1H has been omitted. So while both these sections were in place, there was always an interplay which was discussed, at forums like this, which will take precedence, which will come in first. So now all of that discussion is just put to rest by one single amendment. 206 CCA, which is just the parallel of 206 AB for TCS, is also omitted. And in respect of LRS, that is your remittances abroad, TCS threshold has been raised from 7 lakhs to 10 lakhs, correct? So now up to 10 lakhs, if there is a remittance, there is no TCS to be done in case of remittances under the LRS. Also, if this remittance is for the purpose of education and it is done out of any loan which is obtained from a financial institution, then also there is no requirement for TCS, no matter what is the amount. So even if it crosses 10 lakhs, but it is for the purpose of education, by way of a loan from a financial institution, there would not be any requirement for tax collection at source. So these are some amendments related to the TDS and TCS provisions. I have a couple of things to discuss on 194I, 206AB and 206CA basically. We'll come to it as we go ahead. Now the last set of amendments which I've covered here is amendment to the two penalty sections, which is 271C and 271CA, a very small amendment. Might have gone unnoticed by most of us. I myself studied it only when I had to speak here. So the amendment says, so in in the present act, okay, right? I mean, the Finance Act 24 or the way it was. So the penalty under this particular subsection, now 271C penalty is basically for your failure to deduct any tax at source. Likewise, 271CA penalty is for failure to collect any tax at source. So the onus of this penalty is only to be applicable in cases where prima facie there has been a failure to either deduct or collect tax at source, right? After deducting or collecting, if there is a delay in payment, we have a separate set of penal mechanisms in place. This is the limited scope of this section. So earlier it read that any penalty under subsection 1 on could be, shall be imposed by the joint commissioner, right? Now, instead of joint commissioner, what is changed by Finance Act 25 is any penalty under subsection 1 on or after the first day of April 25 shall be imposed by the assessing officer. The change is same in 271C as well as 271CA. So to my mind, this is kind of expanding the scope as to what kind of cadre of officer can levy the penalty. Earlier it was restricted to a joint commissioner. Now any officer who is the assessing officer will be empowered to levy the penalty in this case, right? We'll come to a small discussion on 271C as well in the coming slides. That's more or less generic. Last amendment of 25 which I am set to cover here is in terms of section 276BB, which is basically a prosecution provision, and it was there for failure to pay the tax collected at source. So the akin amendment for this already took place in Finance Act 24, where they moved on with an intent of decriminalizing the TDS related defaults. So that small change corresponding to the TCS provision was pending, which has been taken care in Finance Act 25. So what this says, this provision says that if at all the TCS has been collected and it is deposited at any time before you are supposed to file the quarterly statement in terms of section 206C, then there will be no prosecution which will be initiated. So it is a relief granting provision so far as the person is in default in terms of paying the tax which he has collected, right? All right. So this is just, the dry part of taking you through the amendments. Now we'll move ahead. We'll just step back a bit and look at some of the amendments which took place in Finance Act 24, which are again related to TDS, right? Any idea how many times the Income Tax Act was amended right from its inception till 25? So I never read all this until the new bill came into place. So as per literature around us, 4,000 times at least the Income Tax Act has been amended from 1961 up to 24, and that is what the literature around the income tax bill, that is how it introduces that, that is the complexity of the law. Did we really need a new income tax bill? We'll come to it later. I have to remain awake and I have to keep all of you awake, right? All right. So these are a couple of amendments which were there in Finance Act 24. So they were basically slashing down of rates of TDS. As you can see, most of the rates went down from 5% to 2%. And 194.0, which was for e-commerce operators, went down from 1 to 0.1%. Correct? Then 194 was omitted. Apart from that, TDS on buyback of shares. Now, because of dividend distribution tax being kind of rolled back, dividend is now again taxable to shareholders, and a corollary of that was buyback related TDS was also to be made in the hands of the shareholders. In case of delayed payments of TCS, where the tax is collected but it is not paid, there was an anomaly in terms of the rate of interest if you compared it with the TDS provisions. So last year they brought it at par, saying that okay, TDS may 1.5% is what is to be paid for the time from when you deducted it till you actually paid it. Same applies to TCS. So that was kind of normalized there. A very welcome amendment last year was, reducing the limitation period for TDS related defaults, correct? So I think non-residents के लिए there was no clarity only कि कभी तक notice आएगा in terms of defaults committed for TDS related compliances. But as far as the provision now goes, so the time limit for deeming a person as assessee in default is now, no orders in this regard can now be made for a period of 6 years from the end of the financial year, or 2 years from the end in which the year in which the correction statement is filed, right? This is now also applicable to non-residents. So this was a welcome change last year. I'm just recapping what happened. And 194IA, which is TDS in respect of immovable property, there always used to be a question whether the threshold of 50 lakhs has to be applied qua property or qua owner. So let us assume there are two owners who have sold a property, right? How would you apply the limit of 50 lakh, whether it would be per owner? So there was clarity saying that the threshold has to be applied qua property. Apart from this, the provisions for lower or nil rate deduction for TDS certificates, those were extended to cover TDS on purchase of goods and also TCS on sale of goods, which was 197 basically. Those was not there earlier. Section 194C, I'll come to the penalty part after I discuss the next two. Section 194C, they very categorically mentioned that work which is defined in terms of that section will not include any sum which is referred to in section 194J. So that is an intent to kind of make it mutually exclusive. I'm still not sure whether it simplifies things or no, but at least an attempt is being made. And the last thing was, for salaried people. Very rarely there are some provisions which come in chapter related to salary which bring some smile on the faces of people who are earning salary. One such instance was last time where they said that, if there is any other income or any other TDS as well as TCS which has been made in the case of the employee, he can disclose it or he can inform the employer about the same, and that will be factored in when his TDS in respect of salary is made. Now this is especially useful when there is TCS on items such as foreign travel or LRS remittances. So that TCS is a substantial amount and it can go on to reduce your amount of tax which is deducted and spread over through the entire period of 12 months. Likewise, any other income and corresponding TDS thereon, that also can now be informed to the employer. Now coming to 271H, which I have mentioned here. So 271H is basically penalty wherein there was a delay at the taxpayer's end to furnish their returns, correct? Before this amendment, the taxpayer was allowed a period up to 1 year to furnish his returns, right? Now, last year this period was shortened and they said that whatever TDS related statements are there, you have to furnish them within a period of 1 month from its due date, as against 1 year which was allowed earlier. So there is no change in the provision of late fee or anything, but the idea behind this seems to, if you allow a lot of time to the taxpayer to keep on submitting their returns in a belated way, there was a difficulty because of late filings and the corresponding credit and those kind of issues. So to mitigate those, this timeline has been reduced. Okay. Now we have come up to speed as to what were the amendments which took place in Finance Act 25 and Finance Act 24. Now let us all try and interact a bit and see how and where are we heading with all of these amendments that are introduced or the logic behind the new bill, right? So first is there was an increase in threshold this year and there was a lowering of rates which took place last year. The amendments which lowered the rates came into effect from 1st October 24 because obviously it was a July budget last time around. And the intent seems to be that, like I said, providing more liquidity or cash flow to the taxpayers per se. But between October 24 and Feb 25, it's a very limited period of time, right? Or let's say July 24 and Feb 25. Why were these changes made consecutively? Especially when the government was working on a new bill coming into picture. Why is it that all these changes happen in a staggered manner? So my idea here is thinking out loud that if there was something which was on the anvil, that okay, these measures have to be rationalized, why are they staggered over a period of 2 or 3 years? Why not kind of introduce them all at once? Because what happens is, I'll give you an example, the rate for TDS on rent, right? It was 5% earlier. It came down to 2% with effect from 1st of October 24, correct? Now, many people ended up deducting tax at source at 5%, right? Because it's a very difficult task when you're in doing a business to keep up with speed with all of this. Now what has happened is while TDS was made at 2%, it is a PAN-based TDS, right? It's not a TAN-based TDS. So when it reflects in your 26 AS, it is reflecting at 2%. Because now the rates have changed to 2%, right? The last month you ended up making a TDS at 5%. Now what is the mechanism to chase the 3% refund? I'm sure there might be some procedure, or if there is not, someone will make some representation and there will be a procedure which will eventually come in place. But the point is, this is a hassle, right? Because these rates were changed somewhere middle of the year, aligning all these things together is a challenge that has happened. Second part here is 206C1H, which is TCS in respect of sale of goods, correct? It was introduced by Finance Act 2020, which was the COVID year, right? Its applicability was deferred, and I believe finally from 1st October 2020, the section came into application. 1st October 2020, the section came into application. There was a lot of discussion about how will the GST be impacted, how will our ERP systems, because all the players who were affected by these sections were like big time industries, right? If the turnover threshold and the transaction threshold was set at 50 lakhs and 10 CR and those kind of astronomical figures. So the people who were affected by it were using all complicated ERP systems. They came up to speed to understand how to implement all of this in their systems. And come July 21, 194Q was effective. So 194Q was like a twin provision of 206C1H, but from the perspective of purchase of goods. So one is affecting the seller, other is affecting the purchaser. So what could have been the rationale of introducing both these provisions at such a short gap and complicating things? And now after 4 years down the line, where so much of ink has been spilled on how to align these two sections, which section gets precedence over that, everybody has aligned their GST, accounting, invoicing, declarations, everything is in place. Now they say 206C1H is sunset from 1st April 25. So it is very difficult to find a sense of continuity or a thought process in the way in which these amendments are brought out, right? This is my thought, right? I'm not speaking for anybody else, but when I study this or when I read this, I can't seem to find any connection between why this is happening like this. All right. So this is about 206C1H part. Now let's come to 206AB, right? I remember attending some budget seminar when this provision came in, and I think it also came in somewhere around 2020 or 21 only. Somebody said this is a draconian provision which has come in the Income Tax Act. Because as a payer of income, how am I going to identify whether my recipient has furnished his return of income or no? For how many years has he been in default in furnishing this return? And what is the quantum of other TDS or TCS which is made in this case? Those were the criteria for being a non-filer, right? After we came to terms with all of this, after we coped with all of this, and there was a very robust system which was developed by Income Tax Department as well, wherein you can put bulk PANs and just ensure compliance with these provisions. Now they say this section is omitted. So even though this section is omitted, right? What happens when I don't furnish my PAN? Or what happens if the PAN which I have furnished is perhaps not linked to my Aadhaar card? I am still under some default in terms of section 206AA. While 206AB and CCA speak only from the perspective of a non-filer of return of income, 206AA talks about a case where your PAN is inoperative. So even though this higher TDS rate won't apply to you, you will still have to be alert enough to check for 206AA applicability, and the following scenarios could take place. One is your PAN is furnished, your return of income is filed, your PAN is operative, so there is no risk or element of higher TDS rate, right? Second situation is your PAN is furnished but your return of income is not filed and your PAN is operative. So ideally here you could have been hit by 206AB, but now because the section is omitted, you will not be hit by 206AB for being a non-filer, and because your PAN is operative and it is furnished, you will not be hit by 206AA as well. Secondly, your PAN is furnished, your ROI is filed, your PAN is not operative. It's not linked with the Aadhaar card, perhaps. So despite the fact that you have filed your return, you will still be liable for making a higher TDS deduction. And lastly, your PAN is furnished, your return is not filed, your PAN is not operative, still you will be governed by the higher rate. So just because 206AB is gone, you still have to check implication of 206AA in cases where PAN is inoperative. I'm sure that might be a very negligible amount of cases now, given that so much time has been provided to link your Aadhaar and PAN cards, but as a payer, we still need to be aware of that. So these are some implications which I tried to cover here. Moving ahead. So when I spoke of the amendments which took place in Finance Act 25, right? 194B, winnings from lottery, crossword puzzles, etc. Like I said, the words aggregate of amounts during the financial year have now been removed, and you have a single transaction limit of 10,000. So the implication here is you're not required to aggregate things on a year-on-year, on a entire year basis. But once your single winning from lottery crosses the threshold of 10,000, you're liable to deduct TDS in this case, right? So one question which comes to my mind here is, because the TDS here is now to be made on a transaction basis, it is not confined or restrained to a particular financial year, right? What happens if there is something of the earlier year where TDS was not made? Because that time maybe that aggregate benchmark was not crossed, or I'll give you another possibility, right up to April 23, right? April 23, online gaming was not a separate section. Those were also covered in 194B. So if there is a single transaction there which had crossed 10,000 and you had not made TDS in any earlier period, right? Will that also have to be taken into consideration once this amendment is rolled out? See, the obvious answer which comes to our mind is no, it seems a bit far-fetched, but the creativity at which the tax administration works, I don't know whether we can be so certain about it. So while this hints at a transaction to transaction applicability for TDS, they have to at least put in as a word of caution that this is applicable from this date and it won't affect the earlier winnings from lotteries which have remained not amenable to TDS in the earlier year. That's my small thought around it. Right? Now we go to the next section, which fascinates me because I don't know, firstly, the first thing that all of us will remember when we read this is there was an anomaly in the budget speech, right, when it was mentioned that the threshold for TDS on rent is raised from 2,40,000 to 6 lakhs in terms of 194I. And when we look at the fine print, it says that your threshold will increase wherein, you know, it is 50,000 per month or part of a month. Correct? Now, this change seems to have been come into picture to align it with 194IB, which is the other section for individuals and HUFs in case of rent, right? But the rate is still different. It's 2%, 5% and 2% that was brought down to 2% last year. Now here, I'll give you one or two scenarios. Please be with me. Earlier, you had an annual limit of 2,40,000 to be checked, correct? So right through the year, if my rent was not crossing 2,40,000, I did not worry about deducting tax at source. Now there might be a situation where in a particular month, the amount of rent has crossed 50,000. Let's say it's 60,000. But the rent contract was only for say 5 months, 6 months, or a period wherein, you know, the total comes to say 1,80,000 or 2 lakh, something like that. So even though my original threshold of 2,40,000, which was the pre-amended section, is not breached, right? Because that 50,000 per month or part of the month criteria is fulfilled, I will have to deduct TDS in that particular month where my monthly rent crosses the threshold of 50,000, which seems to be slightly misaligned with the intention with which this provision was brought in to give a TDS the TDS relaxation up to 6 lakhs per annum. So this is one aspect which I wanted to highlight here. There could also be a situation wherein right throughout the period, for some months your rent would be less than 50,000, let's say April, May, June. Then there might be a revision in rent and your rent would go up to say 60,000. So then you would be under an obligation to deduct TDS henceforth, as in the moment when your rent is crossing the threshold of 50 and the earlier 3 months would not be affected by the TDS provisions. Now this section comes into effect, or this amendment comes into effect from 1st of April. So as we go ahead, we'll see what other kind of permutation and combination related queries would arise in terms of this section. Okay. Now here, before 271H I discussed. Now just to listen something from all of you. I'm sure even here at this forum, are sessions interactive or no? They are. Okay, nice. So there's so many seniors in the profession here, right? So 221, and this I seek from a knowledge perspective. So 221, we have a penalty, right? Which is for failure of payment of tax. And 271C, we have a penalty, which is for failure to deduct or collect tax at source, correct? Now, are these two set of penalties which are applicable, are they exclusive of each other? Are they exclusive of each other, 271C and 221? Yes? So you would like to say something more? It is exclusive of each other. So can 221 still be levied in a case where 271C has been levied and there is a failure to even pay the tax which is deducted? Okay, let me just recap this whole thing for my own benefit, right? So earlier, if my understanding serves me right, there was a prosecution provision, 276B if I'm not wrong, and there was a penalty provision. So this was prior to 87, right? Prior to 87, the prosecution provision came into force even though there was a non-deduction of tax at source. Later on, they mentioned that the prosecution proceedings have to be initiated only for a severe default. And a severe default is where you have deducted the tax, but you have not paid it. If you have not deducted the tax at all, the penalty has to be monetary in nature, and it cannot be like a prosecutory in nature. So 271C spoke of a situation that you fail to deduct or collect tax at source, penalty is leviable. 276B or BB was amended in somewhere in 87 to say that prosecution will be initiated only if there is a failure to pay the amount of tax which has been deducted. So those two things were separated. Now 271C has a very restricted application. It says that if there is a failure to deduct or collect tax at source, then the AO can levy penalty in that case. Whereas 221 speaks of a situation where there is a failure to pay tax. So one trigger is failure to deduct tax, which is going to initiate 271C. Second failure is to pay the deducted amount of tax, which could initiate 221. So there are two distinct penalties. Now 276BB could also come in when there is a failure to pay the deducted amount of tax. The relief granting amendment which we just looked at some time back, right? Now between 271C and 221, there were so many rulings which, there are two views basically. One view says that if you are having 271C which is triggered, 221 need not be made applicable. The other view says if 271C is triggered, it is independent and exclusive of 221, which is on a different footing. So I have read a summary of a couple of rulings. The favorable view, of course, seems to be the second one, that both are actually not connected and they are exclusive of each other. That also leads us to another debate. So is it necessary that for levy of 271C, there has to be an order which states that this is an assessee in default per se? Any views here? So an assessee in default is an order under 201, right? I'm sure everybody knows. So is that order a prerequisite for me to initiate penalty under 271C? Yes? Okay. No? Anybody know? I will just read the first line of 271C. Please forgive me, I'm a teacher at heart, so the provisions have to be read no matter what. So if we look at what 271C says, it says if any person fails to so and so, so and so, so and so, then such person shall be liable to pay by way of penalty a sum equal to the amount of tax such person has failed to deduct or pay. Correct? So if any person fails to deduct whole of the tax or part of the tax as was required. This is what 271C reads as. Is it mandatory for any proceeding to be in place for levy of 271C? Let me reframe what I am trying to ask. Okay. Any other answers? That is what I'm trying to build up. So basically, it is a common understanding of how the law is that if we are penalized for something, there has to be a proceeding, right? How else do you explain the levy of penalty? But if you look at how 271C, it is a very plainly worded section. It is not indicating that there has to be some proceeding or there has to be an order basically claiming that this is an assassin default. So again, here there are two views, but unfortunately the view which is more alluded to is the view that there need not actually be a proceeding in place, or there need not be an order in terms of section 201 putting the SSE or tagging him as SSE in default for levy of penalty under 271C. Irrespective of that, the penalty proceedings the penalty can be levied by the assessing officer. So that is, I think, a small differentiating factor, I would say, from the usual understanding of penal provisions that are there. Okay. So once there is an order treating you as SSA in default only, then they can go ahead with in the same order they will levy the penalty. Okay. That is where the other view is supported, but from a legal perspective, yeah, correct. It's the same order which does it. Now, correct. Correct. So levy cannot be automatic is what you're trying to say. You have to hear the other person out. Correct. That is because you're covered by the proviso that is there, the exception which is there in case. Whether there's a reasonable cost to not deduct TDS. Okay. So, in this context, I'll just bring to the notice of everybody a 2023 ruling of the Supreme Court in the case of US Technologies International, wherein it was, it's not alluding to anything that we discussed here, but it just says that once tax is deducted under the relevant provisions, 271C penalty need not be invoked. So, 271C trigger is only failure to deduct tax. Whether you paid it or not is not a footing of 271C. Right. Okay. Yes. Correct. So that delay was it was considered as paid because he. Yes. And on this noting, I have another 221 cannot be imposed in cases of non-deduction and short deduction. This is a very old ruling actually. It is in the case of Titagar Steels and it's an ITAT ruling. I'm not sure about its status presently, but this is one small support we have in case of 221 not being levied for cases where there is a non-deduction. I think when we are looking at how a particular provision is to be examined, more than non-compliance or compliance, the intent of the taxpayer also has to be seen. Just like in this case, he deducted it though belatedly, but he complied with the provision. So there was no intention to escape or not comply with the provisions, and that is how I think it has been handled. Yes. It will be allowed, right? In which case? Correct. But Like you said, 40A, when you subsequently comply, it gives you an allowance of, that is up to the time frame of furnishing your return of income.
What happens if you have not done it at all? See, many a times you have not deducted and therefore there is a disallowance. Subsequent year you deduct, but you have no way of recovering that deduction. So maybe sometimes you let it go. So what happens? Then 271C comes into play. Is that the idea?
That seems to be the literal interpretation, yes. But
So they're holding you responsible under two different sections
for the same default, yes, for the same default, right. But then one provision, yes, sir. Events, right. So effectively 271C and 221 are different and they could be levied at the same time. Yes. I'll just share my thoughts over that question first and then come back here. So if I'm just saying it aloud all over again, when I don't deduct tax in terms of my business allowance, you're giving me a disallowance of 30% of my expenditure, correct? Assuming I pay it subsequently in the next year or wherever, you're giving me a allowance, so as to say, in terms of my computational provisions. But then I always run a risk for that particular year wherein 271C could be levied. But won't I be in a position to prove that I've complied with the provisions later on, if I have?
In the subsequent year, therefore, if you have deducted and paid, will the 271C for that particular assessment year still apply? That's the question. Where you have not deducted.
Ideally, it should not, because I have complied with it.
Or will the law take a slightly benign view, saying that, okay, for whatever reason you have not deducted, your intention has not been not to deduct?
I think the SC ruling which I just read out previously seems to be on similar point of law. So subsequently, if I have happened to deduct it and pay it, I think I can be excused from 271C.
Somewhere yesterday there was some clause that said here there's mens rea and here there's no mens rea.
Okay.
I wanted to say something to unlike 271(1)(c) and the other provisions where the mens rea is a criteria, is it here or is it not? That is the whole idea.
I would take a different view here, so as to say that if I examine 271C, right, it is strictly a compliance. It's a trigger for not complying with the provision. So while you're targeting me or you're penalizing me by disallowing my expenditure in terms of 40A, even if there was any guilt or any mens rea element, I have already been, so as to say, punished for it by disallowing it. And when I comply with that provision later on, I humbly say that 271C, I can still fight it out. And yes, now I'll come to the other question where it's very interesting. It's always puzzled me that 221 and 271C, they are disjoint. The triggers for those two events are different. There is no sort of overlap in it, but still somewhere it feels wrong. Yeah, so, right. Correct. So you just made a statement that if I have not deducted, how will I pay the tax? But there are a couple of provisions, wherein when you are passing on any benefit or anything where you don't actually deduct, you are supposed to pay it, like 194R, for example, or these winnings related sections. Correct, but you still ought to pay it, right, before you deduct it. Right. So you have to add something.
I think 221
Deducted it. So you're trying to say 221 is a more graver default in terms of 271C, because ideally you are sitting with somebody else's money, so as to say.
it is not your money.
Correct.
Deducted from somebody, so you have deprived and not paid. So you are depriving both the government and the person deducting, let us say, of the rightful credit and the amount which are due to them. So I think 221 is certainly great.
Accepted, but what happens if, just building a case study around it, supposing I have not deducted tax at all, so 271C is the levy that comes into picture. It may be a bit far-fetched to bring in 221 at this stage, because like is the literal interpretation that you can't really pay what you have not deducted, that impossibility of performance so as to creep in. But let us say I deducted it, right? I belatedly deducted it. So that is also a slight default in terms of 271C, saying that I didn't default it when I didn't deduct it when I was required to. And I paid it, or rather I've still not paid it. So here, I think I am now sitting with the money which ideally should have reached the government some time back. So that is a more serious default in my case, and 221 is inescapable. Even though I might take some leeway for 271C, saying that okay, later on I managed to, kind of pay it out, but 221 will still fall on me.
I think for business income, if you have already penalized the businessman for not deducting tax at source and giving you a producer disallowance, which can be quite high. 194C, the percentage is only 1.
Correct.
The amount involved and the amount, the penalty that you would, the disallowance that you take is quite large. So I think in terms of, if you look at it, look at 221 and 271C, I would think 271C is reckoning.
Okay.
And I don't know whether 271C was required. Like you say, what is the intention of the legislature behind all these amendments?
So somewhere I feel interest part fell short, right? So people would have started calculating that okay, for a delay I just have to pay a 1% per month till the point in time that I actually deducted, and they would have their costing analysis into place. So they needed a larger trigger, is how I look at it.
And the kind of calculations that happen, believe me, even at micro percentages. I remember, I'm an old timer, I've been a chartered accountant for more number of years than probably a lot of young girls and boys are here at their age. I remember going to the income tax department, chasing a refund and trying to get the money back, okay? And instead of the client being happy, the guy said, "तेरे को कौन बना follow up करेगा? तो interest मिलेगा ना? इधर तो कुछ नहीं मिलता है."
Correct.
So that was his logic. So he was not happy with the refund coming in. So the mindset of a businessman is completely different from the mindset of a professional.
It all rotates around the working capital cost and the cost of non-compliance and the interest that one would have to pay.
And the kind of thought process that goes on in the mind of the businessman is something that a professional, unfortunately or otherwise, is not able to fathom.
Yeah.
And therefore, a lot of
Because we don't resonate with that thought process.
and therefore a lot of professionals get into trouble.
Correct.
If you ask me.
Correct.
Because the way to hell is paved with good intentions.
Right. I'm too small a person to give a conclusion, but I'll give you my thought process. I think both can be, both do hold a place for simultaneous application, though this might not sound the answer a consultant would like to hear. But if I speak from a thorough legal perspective, both are, like you said, separate events with different triggers and different implications. And to my mind, yes, 221 is more graver a default, because I am already sitting with the funds on hand and not showing any intent to deposit it. Whereas 271C could still be forgiven if I go and comply with it ahead. No, would have to check the recent notice element part, but this has been in discussion since some time now, at least. They don't go to 221 these, because I believe people end up paying also. Once they deduct, nobody would sit with the funds considering the prosecution fear that is there. Right? For that is also one deterrent, I feel. All right. Thank you. I have another 2 hours to pull through. I would request you to save that compliment. All right. So I think we'll move to the next part now. There's supposed to be some break at 3:45 or so. We'll cover a part of the transition provisions, take a break, then come back to the transition provisions, and then do a couple of discussions around them and some discussions around 194 R and O, because what Ashok sir told me, he was not able to pick up O and R because of paucity of time. That was the second session you all had yesterday, is how I am informed. Okay. So, yeah, now I want to ask the first question that I asked somewhere random. Do you really think there was a need for a new tax bill? And if yes, has it met our expectations around it? No. Nobody would say it loud, I know. But somewhere it's disheartening. I'll tell you what. While I was researching up articles around TDS because of this talk and all, I came across a 2018 article in BCAJ journal, which was the golden year for them for 50 years completion. And that article was written by Gautam Nayak sir and Pradeep sir, right? So there actually they have a series called as View and Counter View. And there they had put up a question that do we really need a new income tax code? This was way back in 2018, right? I think in 2009, the government made an attempt of bringing out a new tax code and all of that. I had just cleared my CA that time, okay, in 2009. So I was all excited. There was a booklet which was released and we all had purchased it. And then suddenly the whole talk around it died. Then in 2018, so this article I came across just last week, and very nicely in a balanced argument, both sides have been put up that whether we really need a new law. So I'll tell you the points for it, because somehow in my mind I was not wanting this kind of an income tax bill. Now if you look at the way the Income Tax Act is drafted, I agree it's complex or it is cumbersome or it has too many difficult jargons, languages which people usually might not find it easy to comprehend. But if you look at the kind of drafting which has come out in the new bill, I'm not here to criticize anything or anything, but I'm just drawing a parallel in terms of the timelines that we are in. Despite all the technological advancements and all facilities at our disposal, the level of legalness in the new bill is way too less if I look at the 1961 Act, right? So there were a lot of ornamental language notwithstanding, subject to whatever other things, but that was the beauty of the law. So as a student of law, I will miss all that terminology when I look at the bill, which has freezed all the 40, 50 odd TDS sections in 3 lengthy tables, right? And it is so confusing to actually look at kidhar kya hai, kidhar specified person hai, where resident is covered, where non-resident is covered. So while people are congratulating them on deleting redundant provisions, yes, that was needed. But eliminating provisos is like, disabling the entire process of legal interpretation is how I look at it. Because when we study interpretation of law, how to interpret a proviso, how to understand the exception was something which was the essence of it. अब उसको ही निकाल दिया है. So I don't know, I'm still mentally in a state of shock to come to terms with it. Yes, sir.
But over a period of time, it will still creep in. The bureaucrats have not been given a free run. That is why the new income tax
idea.
as the, and this is more practical and more, and like I said, for once, the bureaucrats have not been given a free run. So this is the third time, apart from 2009, 18, and this one again seems to be a completely new one. Because I remember a very eminent speaker, chartered accountant and a PhD doctor, Dr. Girish Ahuja, speaks very well. I'm sure everybody heard him. And when he was in one of the seminars at that point of time saying, I'm not able to, I'm not allowed to talk more, I can't say more, he would still say
Ah.
definitely, but but what we are coming up is going to be a game changer and things like that. I'm not too sure whether that is now good or whether it was
Okay.
Madam's own brainchild, which she put it in one budget and made sure that in 6 months, 8 months, we'll make sure that everything will happen, whatever it is. Probably the framework was already available to a large extent on the basis of what Dr. Girish Ahuja and team did. And therefore, what has now come out is probably making a lot more sense and lot more easier to read in terms of understanding the law as compared to what
Earlier version.
I would think so.
Yes. And like you were saying, sir, it'll creep in. Certainly, of course, any change is difficult to digest it first. But it's just that I'm not very sure it's a new bill. It's just the old law in a new form, I would say.
And if you are referring to Gautam as Gautam Nayak, I have always felt that he should have been in the committee.
All right. So yes, coming to how the bill has shaped so far as the TDS provisions go. So there are different views here. Some literature says there were 43 sections related to TDS.
Is that tea break or no? What is this?
340?
You're not doing the second part, right?
Yeah. I'll just do a part of the second part and break. Is that okay? You want a tea break? I'll do it right away. All right, that is also well. So we can start the second part after the tea break. So we'll go ahead with the second part of my presentation today, which is just highlighting some comparisons between the old act and the new bill and my thoughts around it. So yes, I think all of us have seen the mapping, which typical book which was released section wise. Now, like I said, there were close to 50 sections related to TDS, which have been crunched into 2 sections, right? And majorly all the payments, including 195, have been put into one section, which is section 393 of the Act. And on account of TDS, the number of reduction that has happened in terms of words is 12,847. Correct? This is the total reduction attributable to TDS sections. Earlier TDS provisions were housed under chapter 17B. Now it is chapter 19. And 192, which was TDS on salaries, is now 392. Most of the section is retained as it is in the same format. However, all the other sections, from 193 to all the sections in between, right up to 196D, all of them have been clubbed as different clauses under section 393. Right? So when you look at the new bill, it is one section which starts with some subsection 1. Then there are close to 3-4 tables. And then you have subsection 4, 5, 6, 7, 8. And then you have lot many notes around it. Now these tables are for 3 categories. Typically TDS on payments which are to residents, to non-residents, and then there is any other person, which includes payments such as winning from lottery, crossword puzzle, the new section on partnership remuneration, etc., wherein resident, non-resident, any kind of pay is covered. Now this is just a mapping which I have done with respect to what was there earlier and what is there now. Correct? We might not go into all of it in detail verbatim, but I will just bring out the important points here. So, like I said, all TDS provisions are now housed in 393 Similarly, all the TCS provisions are now housed under section 394, correct? All the provisos and explanations are done away with. Instead of that, you have tabulated version with notes underneath, correct? So they have maintained separate sections for all that you can see on screen. For example, direct payment 191, which was there. 391 is just the replica. 192 is 392, which is salary. Certificate related provisions, all of them they have clubbed into one section, which is called as 395. And TDS and credit for tax deducted, they have clubbed under one section, which is 390. I'm not going to read through all of this list. I've just put the mapping on slide. Now I have, while we view it, I just have to bring a contextual point in perspective. So for safety's sake, I'll say that section 393 is the main section as far as our TDS provisions go. And the tables that are given beneath it categorize the TDS in respects of resident, non-resident, and other person. But if you look at the way the section starts in the new bill, it says where any income or sum of the nature specified in column B is credited or paid or distributed by the person specified in column C during the year to a resident. So it is paid by a specified person, but the primary section still makes a hint at to a resident. And then they have tables wherein the payee is a resident, or the payee is a non-resident, or the payee is any other person. So perhaps in my mind there is some anomaly here, but it's a testing phase and we'll all see how the final print comes out, right? Now I have a couple of points to share here. There's an intention why I have not put all of them on the slide, just two I have put there. So let's go section by section and I'll just tell you what is how I think of it. So if you look at, let us say section 194R, which is TDS in the case of benefits or perquisites. So while it was introduced, we didn't have any meaning per se for what constitutes perquisite or what constitutes benefit. We still don't have it under the new bill. So that lacuna of what precisely is intended to cover still exists even under the proposed new bill. Now there were certain guidelines, right, which were introduced in the context of online gaming, 194R, and even in case of 194O. Earlier, if you look at the section the way it is right now in the Income Tax Act, the section itself gave an authority for those guidelines to come into existence, that to remove any difficulty in implementation of these provisions, so and so guidelines may be made in this regard. Now, while I have tried to understand how this has been factored into the new clauses which we have under 393, but I don't seem to have an answer as to how this guidelines or these notifications which have come in the context of these newly introduced sections, how will they be factored in when we are looking at the tabulated version? That is one thing. Second thing is, we used to have definitions in terms of work means, right, or fees for technical services. We still do have them. But then the cross-referencing that is there, if you look at the table right now, so it speaks clause 8, say subclause 4. So the cross-referencing is yet more difficult to grasp as it was earlier, because earlier we used to have a plain explanation which said that for the purpose of this subsection or for the purpose of this section, work means or includes so and so. So right now all these special finer aspects which have to be given out are given out by way of notes which are succeeding the sections. So cross-matching it with the point in question is going to be a slightly tedious exercise. Yes, we all will get used to it, but that is one thing. Now, there were a lot of ambiguities in TDS related provisions even earlier. Unfortunately, all of the same have been carried forward as they are while packaging the sections in this tabulated form. So we all could have been greatly helped with certain definitions, like I said, in terms of 194R or in terms of 194O, right? If there would be some clarity as to what comprises of benefit, perquisite, some clarity on the digital platform or the receipts that are in question, but that kind of clarity is still not afforded to. It is just a copy paste of majority of the language which was there in the original section, right? What is also important to note is usually when we understood TDS, we always grouped it into three pockets. First pocket was TDS on salary, which operated on a different mechanism. Next pocket was TDS in respect of payments to residents, which had its own sameness, like TDS has to be made whenever amount is paid or credited, whichever is earlier kind of mechanism. And the last one was TDS for non-residents, which was altogether a separate section under 195. Now that is absent in the way this new bill is packaged together, and 195 is also a part of the same clause 393 that is there. So there are certain aspects like rates in force or the treaty availabilities or grossing up or what is the sum which is chargeable to tax, whether any kind of amount is included or not. All this used to be very clear when we looked at it as a section per se. Now the crunched version of it, to my mind, I think it will take some more time to understand if all the elements of section 195 have come out in the new version which is brought out, right? That is one aspect. Now here I would just like to ask any one of you if you have got a chance to apply your mind to that. When we look at these sections wherein the section gave way for the delegation in terms of guidelines or notifications, absent a reference like that in this kind of a tabulated version, I mean, how would the rules shape up, after this bill comes into picture? We have so many rules when it comes to valuation, right? For 194R, you have the entire 133 rule for online gaming. So the cross-referencing here, I think, held an important part in the way the old law was drafted, which in my humble understanding, I'm not able to correlate in the new bill which is before us. So any which ways 194 guidelines have always been a point of contention that whether they are valid or not. Given the fact that assuming there is no strong reference here saying that these are brought in to mitigate difficulties or so, does that change anything from a legal standpoint? Yes, no? Can't say.
I think if there are no clarities to these points that you just mentioned, then mitigation is inevitable.
So one thing I would just say is a benefit of doubt that maybe they are working on incorporating this in ways of some rules or some addendums or some other notes. But the way the section was structured earlier, it gave power. You had a specific point coming in that so and so is empowered to make guidelines in this regard. So either they need to incorporate it by way of a blanket provision in the points only is how I look at it. Otherwise, yes, there are going to be questions around its validity, and again everybody will be reinventing the wheel, whether this is valid or not, and it will be a lot of chaos in my mind. Okay. Now having said that, the rates are also given in the table only, which is fine, because except in case of 195, which always gave a reference to rates in force, most of the TDS rates were well documented in the rate itself. And here also, so far as 195 is concerned, you still have the rates in force point mentioned there. Now, speaking of 195, there is this small difference which I want to highlight. So, presently, that is in the Income Tax Act, we have explanation 2 to section 195, right? And that says that the recipient of income, he can file an application to the assessing officer for allowing him to receive the income without TDS. There are two things. One is a lower deduction and another is receiving the income completely devoid of any TDS. Now, correct me if I'm wrong, usually if it's a lower TDS which is being sought, it is the payer of income who goes ahead with the application. And if it is income which is being sought totally without TDS, then it is the recipient who goes and makes an application to the assessing officer. Now, a corresponding provision is not there in the whatever the bill it is currently, right? Also, if you look at, so this is one thing, I'll just recap on the explanation to 195 very technically just to put things in perspective for everyone. So section 195, the second explanation says that, where the person responsible for paying any such sum under this act to a non-resident considers that whole of the sum would not be chargeable in case of the recipient. The payer has to make an application to the assessing officer saying that such amount is not chargeable or not liable for TDS. Now that is one point which I want you all to note. And second point is again in section 197. Now both points in my mind have a linkage. If you look at 197, it presently allows certificate for lower rate of TDS as also for nil TDS. Now the new clause or the new section 395 which has come into the bill, that includes certificate only for lower TDS. It does not include a provision for going in for nil TDS, right? Now, drawing a corollary between both these aspects, it seems to be the case that granting any income without deducting TDS thereon seems to be, they don't want to continue with it possibly, because that has been taken away from section 197 also and from 195 also. So if it is what the way it is right now in this bill, going further, once this comes into operation, I would be only in a position to make an application for a lower TDS. I would not be in a position to make any application for nil TDS or, don't charge TDS kind of a certificate. So, and this seems to be the intent because it's absent at two places. It's not there in 197 as well as it's not there in 195 as well. So this is something which I just wanted to bring it to your notice. Maybe this could change in due course of time, but it is presently like this. So apart from these changes, these specific changes in these two sections, more or less the entire text and subject matter of all the TDS provisions have been crunched into the table with some gaps which I already discussed, like the power or the authority to make bring in guidelines or to make delegated legislation. Those seem to not still have found a place anywhere in the notes part. Other than this, more or less it is just a new packaging for the old law. Okay. So any discussion or any questions with regards to the comparison between these new provisions vis-a-vis the old provisions? So technically, everything has remained the same. Whatever amendments were brought in by the Finance Act 25, they have been incorporated in the respective clauses or sections of the new bill, except these differences and the fundamental points which I spoke before, right? Other than that, I think grasping the table seems to be a challenge, at least to me, because it It reminds me of section 80G or section 11 of the old act, where the text would run into 3 to 4 pages with a lot of cross-referencing. All right. Anything to share on this? Otherwise, I'll move on to the next part. Yes, all right.
TDS will not come
It won't come. So it is intentionally being removed.
intentionally, because at the end of the day, it will be an officer to whom you have gone, who's got to put it in a minor percentage for the processes. And the whole idea is to capture the transaction under the 26 days.
So correct me if I'm wrong, the certificates which have already been issued, let us say, they are operational for a limited period only, which is mentioned on the certificate, right? 197 or so. So assuming this comes into place and there are some certificates which are functional from the earlier approval. So they would have to kind of notify something for that period for them, or it would just be gone and one fine day. I mean, it's a general thought. It's like a corollary of what we discussed. There would be some 197 certificates which would be valid for, let's say, some period even after 1st April 26, maybe 2 months, 3 months. And if this was to go away, what would happen to those?
Does it on a more practical basis will be able to throw light on this? But I thought it ends on 31st of March.
No, the certificate ends on 31st of March, irrespective of any of them.
Okay, so they don't lapse over 2 P tax periods. Then I think any certificate would end on 31st March itself.
Respect of non-residents, which probably is the more crucial area, it is like you say pure transaction.
Correct. Okay. Huh. So if they're not beyond the financial year, the issue is self-resolving itself. Yes. Okay.
The aspect that you've been saying that does not change, not change. As a matter of fact, in all the briefings that the finance ministry has been holding, they have been reiterating the fact that there is no change per se. It is only the language, it is notwithstanding anything.
Yes. So when you read it, you actually don't feel much of a change, only a couple of doubts that how would certain things pan out given the current language which is used in this bill.
Reinvent the income tax law.
Yeah, yes.
Attempted that. They've not
Correct.
bravery.
It's naye packet mein purana cheese, something like that. All right. So I think having said that, let us move to some section-specific case studies and use cases. Yes, sir. Procedural part in terms of? For TDS part, no. That is in fact a question that is there. So many forms, so many statements everywhere incorporating the new bill. There is no guidance yet on that. So that is why I said maybe it is in the testing phase and they would come out with something as to the applicability of rules, guidelines, the return compliances, the annual returns, the forms, everything would have to undergo a change.
I'm sure there will be some changes in the 1962 rules as well.
There would be, because, sorry sir? Okay. There will be corresponding changes in the rules also which might be underway, right? Because for one, the most obvious change is the referencing part of it. Correct. And then there would be so many sections which are done away with, so many procedures which might now not be required or anyways. So it's a very ambitious date in my mind, at least, to see this act ruling out on 1st April 26. But we don't know at what pace people in the government are working, so we should give them the benefit of doubt, I would say.
This will eventually become a notification-based law. It will not capture everything, same like we are facing in GST.
Correct.
Unauthorized service tax, where law is small and you have all notifications
Coming in.
coming around. So because what happens wherever there is an intent
But just to put a fair point in, in a healthy argument to what you're saying is, GST to my mind was a marked departure from the CST law. Whereas here, we have not really changed anything except the way it looks or reads. So in a sense, yes, there will be a lot of things which they would not want to continue, like for example, this aspect which is there here, or but somewhere they would have to bring the rules at par is how I look at it.
Because few of the sections, if we read, where grammatical context are missing, they are changing the interpretation.
Yes.
So all this will create a lot of ruckus in comparison.
43B, for example, I feel is not finding any place in this bill, which is, yeah. So that's why I said a lot is still under heavy discussion.
Even there are legal experts who say that to replace notwithstanding with irrespective, they may sound similar.
But they don't convey the same meaning. Yes, they don't convey the same meaning. And if it comes to an issue where it goes to the courts, it might just throw the interpretation anyway. That is how it is. All right. So I think time will tell. Maybe 1 year from now, today, next year, we all would be listening to someone discuss how this worked and how this didn't work. Hope so. So let's go to 194R. Was it discussed in any of the 2 days? Yes, no? It was? It was touched upon, okay. So because I have picked up 194R and O as a part of my practical use cases scenario. So though it is more or less settled provision now, but it's still a havoc creating provision to my mind. And let us make this as interactive and as two-way flowing as we can. So section 194R, it was introduced in July 22. By now it's settled, and it says any person who's providing any benefit or perquisite to a resident, right? Whether or not in money or in kind, but it has to arise from his or her business or profession, and that is then liable for a TDS at the rate of 10%, correct? So first, some important pointers here. The benefit or perquisite which is paid has to have some nexus or connection to the business of the recipient, correct? So it cannot be out of a personal transaction or something which has no element of business related nexus into it. Secondly, this has to be in cash or kind or partly cash and kind. Thirdly, it need not be taxable in the hands of the recipient. So for the payer to ascertain whether he has to deduct TDS on it or not, you really don't have to see whether there was any tax payable by the other person on it or no. If any benefit is paid to the government departments or units, then that is outside the scope of 194R. And it could also include benefit in the form of capital assets. Okay. So first things first, when 194R was introduced, and I'm sure most of you here are now attuned with why it was introduced, but just to put things in perspective, whenever you have any professional contract or a business transaction which is undergoing, let us stick to a professional contract because we have a 194J in parallel to draw some analogy to. So let's say somebody hires me as a consultant and they are paying me X rupees for an advice which I have given. Now that X rupees which I have paid for this advice is a part and parcel of 194J, correct? Even if I charge, instead of X rupees, I charge a laptop, or let's say I ask them to give me a high-end iPhone or anything else, which is because of the advice that I gave them, it would still be a part and parcel of 194J in my mind. When 194R comes into picture is when I am receiving something which is firstly outside the scope of something which was envisaged under 194J to begin with. So let us say a typical case in point would be, insurance agents who receive their commissions, their commission, what you call them, referrals, but because they meet certain targets, they are incentivized with some foreign trips or some motor car or some other kinds of things. Now these things typically are not a one-to-one consideration for the services which they have entered, right? Or let's say you are a high-end surgeon and you performed some life-saving surgery on a very big short businessman. He did pay you your fees, but out of his gratitude or appreciation, he ended up gifting you a very fancy car or a very fancy gadget. So that is typically outside the scope of 194J in the first place, which is why 194R comes into picture, is how I have understood it, right? Now what happens is, as a recipient, I would usually not show this thing as a part of my P&L. That was the revenue gap which I feel brought about the introduction of this section. So if I receive a laptop, I receive a paid foreign trip, or I receive a gadget, I'm not going to put the money value of that in my P&L credit side saying business income not credited to P&L. Nobody is that honest, right? That is why they decided to tag the payer. Okay, if you are making a payment of any benefit or perquisite, which is because of the business or profession nexus of the service provider, you are supposed to deduct TDS. That is how they tapped me. Otherwise, I was never going to show this as a part of my income. So whatever discussion begins with 194R, we first have to figure out that it is over and above my 194J scope, right? Now this could be a capital asset to me. It could not be taxable in my hands. It could be a trip. It could be anything. But once all the other parameters are met, the payer is under an obligation to deduct tax at source, correct? Now what happens is, after this section was introduced, they came out with two huge guidelines. I'm sure all of us must have gone through it, and it must be in our brains very readily available. They released a fair amount of FAQs and all. But what I feel is the impact of 194R is very profound even in our day-to-day dealings and transactions. It has hit a large variety of transactions, right? So we'll run through these slides quickly, and I have some 5 or 6 use cases which we can discuss in a case study pattern, right? Now here, if it is a negligible cash component, 20,000 se kam hai, all those things are excluded here. Okay, if there is something which I've received in kind, then you have a valuation mechanism which says that the fair market value on the period when it is purchased, or the purchase price, has to be considered as the value of benefit or perquisite. If the payer is manufacturing it and it is given to you, then it has to be at the arm's length price, that is, so as to say what is the price which is charged to its other customers. And then if there is a one-time settlement of loan or a waiver of loan, all those things are outside of 194R, as has been sufficiently clarified by this point in time. Now what is the 26AS implication here? If what I have received is not my income per se, let's say it's a capital asset, okay? For example, I received a laptop. I am a professional, I'm a lawyer, I received a laptop. It's a capital asset to me, but the person who gave me that laptop, he valued it in kind, he deposited the equivalent amount to the credit of the government. Now, how would it reflect in my 26AS? There would be some element of TDS shown against my name for that component, but it may be the case that I'm not showing this laptop as my income directly because I've added it to my asset block and I'm perhaps claiming depreciation. There is a possibility of mismatch. Yes? Oh, why would that be the case, sir?
When you are talking of a very unlikely that some patient does not pay for the professional fees or whatever, and gives you a gift.
No, I am saying he pays the professional fees and in addition to it, he gives me a gift.
So he has given it to you in consideration of certain professional services which have been rendered by you, which has ended up saving his life or whatever it is. So I would still think it's a gift, and I would still think that it will be taxed in your hands under section 56. Having said that, if it appears under 26 says and you are not going to show it as income, you are in serious trouble. This is what I mean.
So what if the person who's paying it to me does 194 hour on it? Okay, so let's say he's a, like I said in my example, he's a businessman. He's a very big shot person, and he was, let's say, a very important person to his business. So saving his life meant a lot for his business, and out of that he's given you this, and there is a 194 hour which has happened. Because if 194 hour has not taken place, the entire discussion is out of my situation here, right? I am proceeding on the premise that he has done 194 hour.
I am still of the view that it is your income either from profession or other sources. It will not show as income from otherwise defective notice will
That is what the 26 AS mismatch will lead to a traces notice in my case saying that where is the corresponding income component here.
and the way the department is moving ahead with technology, it will get automatically added.
Correct. Correct. They'll send me that revised income.
That you have missed out kindly, very nice and polite, but there is a stick behind the entire thing. A big disclaimer, apart from any of this, I have a feeling 194R is being introduced by a bureaucrat who hates doctors and the medical system. Basically, it's come out.
Also the insurance agents and the distributors and all of that. But I'll tell you one more analogy for this maybe later. But this 26 AS mismatch, to my mind, would still exist, and I would have to first show it as my income, at least credit it to my P&L. Now, having done that, yes, the fair market value on the purchase date. What basis? That is a question mark. But so it is ideally the payer's prerogative to get the valuation in place. Basis the purchase price, because usually all these would be some standard products, right? It would not be something which is like those rules we had for 11 UA and all jewelry, they are archaeological collection. So I think it would be pretty standardized, but yes, they would have to proceed with the payer's prerogative for valuation. And having done that, having included it in my P&L credit side, naturally it would also take the hit of the expenses I incurred to earn that income. So in a way, it is only the net component of that income which is being taxed in my hands, whereas the TDS is being done at a higher rate of 10%. Maybe my effective rate is lower than that, let us say. So that is also a concerning point wherein you are receiving some kind of asset per se. Okay. Now, these are some scenarios. I'm not sure. Are you able to see them? No? Yes? Yes, sir.
Say for example, if you receive an asset and say that is reflected in 26 AS, say the value is 50,000 example, a laptop is given. So if an accounting entry passes the book, we will debit the laptop which is standing in the UPE fixed asset, and ultimately we have to credit it to P&L.
That is the income component.
Accordingly, we book the TDS as per 194R and take the credit. And then whatever depreciation we claim on the asset income.
This is what I would be required to do if it is a capital asset in question. Otherwise, I would always run the risk of a 26 AS mismatch in my mind.
No, so in that case, say for example, if it is not a capital asset and trip is sponsored, so the practical approach adopted by many is there is no accounting effect whatever in the books. It is not affecting your books. But in the COI, this was disclosed as income from other source and it was just filed. So this is also something which many of them have done. And one of the big four has certified this to be approach.
Okay.
They say you can't bring it to books of account.
So just to think out loud, if it is so very the basis that it has an access to my business or profession, what stops me from bringing it into my business books? Why would I show it as a other sources receipt?
A business
It's not a gift, it's in consideration for my profession.
Tell you what, if this businessman, hi-fi, important person, blah blah blah, has given you, say, a high-end Audi or whatever, because you've been so good, you saved the life of the person and all. If he's doing 194 hours, that means he's going to charge it off as an expenditure in the books of accounts.
Yes.
The moment there is 194 hours, you should be, you, in my view, have to offer it for tax and professional income safe, because then there is no risk.
That is exactly what I'm communicating, yeah.
For life. Be happy that at your marginal rate of tax, you have got something which is worth 100. You effectively pay 20.
Right.
20, 30, whatever. This is ultimately how people got reconciled to the idea of ESOPs.
Correct.
People said, maybe the company has given me the shares and things like that. But ultimately they got reconciled that for a share which is worth 100 on a particular day, you have exercised the ESOP and said 25 rupees. On the balance 75, you paid 30% tax. You got 22 rupees there approximately. So 20, 25, 45
Is
short term bhi karna hai, 150 mein बेच दो. You know? So ultimately people got reconciled to that.
okay. Now here are a couple of scenarios. I'm sure most of us would be aware of many of them. I'm just picking up things on a random basis. So first, for discussion, I have reward points here. Okay, in case it's not visible, the last one on the circle below is reward points. So just some time back, sir seated there said that 194 hours seems to have been introduced by a bureaucrat who kind of, did not like doctors and, the pharmaceutical company per se. Now, way back somewhere in, 2018 or so, all this cashbacks and reward points were a very big rage. Even now they are, but that time was when, we were all the cred and those kind of apps were coming in, and you pay your electricity bills using that app and you get like 5,000 points, MX points, Amazon points, whatever, XYZ. And then you encash those points into meeting some other expenses, or it's like a benefit available to you. Okay, 1 point is say 1 rupee. Even today, if I happen to pay some huge expenditure using my MX card, over a period of 1 year, I get some couple of points which add up to my electricity bill of say 8,000-9,000 rupees in a year. Right? Now, that time back then, all these reward points or so were not taxable, because there was no 194 hour. And a lot of business entities used to actually use credit cards or the Amazon Pay balance to meet their industrial or business related electricity bills, which could run into few lakhs. So imagine the edge points or the reward points which they could get, which could be converted into some other benefit. Okay, maybe they would get some exchange it for some monetary value. It could be encashed in terms of paying some other expenditure. So that happened to be the case in 2018, and cut to 2022 when we have 194 hour. Now just examine that situation in today's perspective, and please let us restrict our discussion to business perspectives only, right? Suppose I'm running a small factory and I have an electricity bill which runs into a couple of lakhs every month. I have a fancy credit card of one of the high-end private banks, and I use that card to meet my electricity bills. Now, because of the expenditure that I'm incurring, I firstly get a rolling credit period of 30 days, 45 days, whatever is my understanding. And because of the high amount of usage, I also end up getting some fabulous benefits each quarter, right? And let's say I accumulate those benefits, and in the end, I can actually buy an asset out of those accumulated points, right? Or I can pay off my electricity bills using those points without incurring any other expenditure, right? Is this a benefit or a perquisite received by me in the course of my business or profession? So there are two questions here. First is whether it qualifies to be one, and फिर कैसे करेंगे is a separate question. Just because we don't have an answer to कैसे, we cannot rule out the क्यों, okay? Is this a benefit or a perquisite? It is, right? It is. So, so bank charges on the card would be like 400 rupees a year max, right? But this is something which is like 10,000 points every quarter, which is close to say 50,000 points a year, which translates to me buying a refrigerator for my office, which is worth 80-90,000 rupees. होता है ना ऐसे? So is there any 194 hour the bank is required to do in this case? It seems far-fetched, yes, but I'm asking conceptually. Is this a benefit? So banks are not doing this, but if I use my Amazon Pay balance, MX is doing it. It gives me such a huge amount of edge points or whatever those points are called every quarter. I practically don't have to pay my electricity bills for 2 months. I can just use the points to do that. Now that I do it in a personal setting is a different situation. But just extrapolate this to a business environment and the businessman in me would be very keen to do this, right?
Nowadays they are giving against which expense we are redeeming those points.
With receiving it is a benefit in my mind. Receiving it is a benefit in my mind.
Yes, I mean if you have spent, you can redeem against these purchases.
So that's a reduction in cost which they are giving me with a rider कि इसको सिर्फ यहीं पे use कर सकते हो, which is okay, but it's still a benefit, right? Precisely, you collect points and then you go and buy something, you redeem it and you buy something for free. No, here the point is, are these banks or these kind of players who are giving these edge points or reward points, they are under an obligation to examine 194 hour in this set of transactions, right? They are, and there are pretty many cases happening also. Just let us quickly relate this same discussion to a case where you have frequent flyer miles given by airlines. आजकल तो कम हो गया है, but अभी वापस Air India has introduced those Maharaja miles, etc. So long back, let us say, assume a scenario when we had, let's say I am a businessman and I travel frequently, right? And I book a certain airline for my travel. All travel is business related. Now, because of the extensive use, I end up accumulating some 1 lakh miles, which kind of sponsors 2 tickets for me, again for my business use, totally free of charge to me. This is also in the nature of a benefit or perquisite, and the airlines in question have to examine applicability of 194 hour in this case, in my mind. So I will answer this question, sir. I don't know if this yes, sir. But is it not your business expense, and is it not a mechanism you are using for your business? They, as in the banks. No, I would doubt that. If you are having a current account, you are having a business, what do you say, your KYC and those elements which substantiate that you are a business user. Individual, no, I am speaking of a situation where it is business driven only. Business of the recipient, no? Huh.
But here there is no business. The recipient is not rendering any services to the bank. Right? So that element of
No, isn't there a transaction between the bank and the person incurring it? Is he not using the card?
no, so as per the section
Huh.
has to render some services to the payer of that benefit, provider of that benefit. Here, the person who is getting those miles is not providing these services to them, to the bank or to the airline.
But he's using the airline for his travel, right?
So it's happening vice versa. He is using their services.
No, no. But in this, so no, no. One minute. Let me come.
You read that provision, no? Verbatim this.
Yeah. So here I would beg to differ because it nowhere says that you have to render service to the person or the payer. No.
Just read that.
Yeah, I will read it. One moment. Yes, any 1 minute. I'll just read it accurately. All right. So it says deduction of tax on benefit or perquisite in respect of business or profession. Any person responsible for providing to a resident any benefit or perquisite, whether convertible into money or not, arising from business or exercise of a profession by such resident shall, before providing this, ensure that tax has been paid. So it requires me to be in conduct of exercise of my business or profession. It need not mean that I do it qua you, right? So by such so exercise of a profession or business by such resident.
If you remove that sentence between the commas, no, and then we can.
It was introduced with to tap all kinds of these escapes from the incomes like pharmaceuticals, insurance agents, and distributors, but it has traversed way beyond its original intent of introduction. That is what I'm trying to say. Now, see, there have been practical instances wherein, now I get your point that I am not providing any service to the bank or the airline, right? But I am utilizing or I'm incurring an expenditure in as a part of a transaction where they are the other party, and that expenditure is incurred for my own business or profession, right? Sorry? No, I'll tell you here, sometime after this section came into picture, somewhere in the early 23, when you would book a airline ticket, sometimes you would have a random form to be filled up that whether this travel is for leisure or for work.
But that is for their own analysis. Not that they are going to deny you any benefit.
There have been instances where we are approached by airlines to examine applicability of 194R in these kind of circumstances.
Actually, you started off 194R by saying that what's not captured in 194J.
Correct, correct,
The spirit of 194R
correct.
and
So,
194J are same.
correct. So here also, when I'm buying a ticket for say 50,000, my original transaction with the airline is for a value of 50,000. The business between me and the airline is for booking a travel for 50,000 and that ends at it. But by virtue of me booking a travel for 50,000 repeatedly for 12 times a year, I have been entitled to another 50,000 free of cost from the airline.
But you are not providing that as a service to them.
It's a business transaction, right? It is not saying that it has to be in exercise of my business or profession.
You do not have access right, but when the airline is giving you quantity discount, when you are incurring a number of that transactions, for them is a business.
Actually, that interpretation is very very clear. If you just remove those
It's perhaps it is not so clear to me because it says exercise of your business or profession.
I get the points whether I'm traveling for business or for personal use. So it's nothing to do with my business.
I would still very humbly hold a different view here until it convinces me, because exercise of business or profession need not be qua your payer. It has to be in effect, right? You look at the circular, you look at the FAQs, the guidelines. While I am fully supporting the fact that they need to be challenged constitutionally, but that is where the imagination has gone because of 194R. All right, we'll quickly move to the next topic. Let us agree to disagree here, but I would still feel there is, the possibility cannot be denied, okay? Then we have cases coming to us wherein they say if there is, now this might sound outright heightened imagination to all of you, is if there is a bonus issue or a rights issue. Let's say I am in the business of investing. Correct? I am a serial investor in companies, and there is a bonus or a rights issue which is coming up, right? Whether it would... Kya hua? Sorry. Whether that would amount to a benefit or perquisite. So X Private Limited may have purchased some shares, they've come out with a bonus issue. Because of my original holding of some number of shares, I get a 1-to-1 bonus. So typically I have got an appreciation, or it's a payout of dividend in a way, right? Whether it's amenable to 194R. I don't have an answer, I'm presenting a possibility that how far 194R has reached. Sorry? No, I'm not stretching it too far. I'm just reading it logically, trying to take it wherever it goes. Huh? Okay. Somebody asked me about OPE expenses also. OPE is, I think, a fairly settled case, right? So out-of-pocket expenses. Let's say I am a service provider. ABC is a company for whom I provided some consultancy, and because of that I traveled and I stayed in a hotel and I incurred some meal expenses. Now the ideal point here, or the guidance available in terms of the circular, says that typically if the invoice is in the name of the entity and they are paying it directly, then no way it can connect back to you. In spirit also, it is not a benefit or perquisite that is available to you, only because of the policy of the way the guidelines are termed, correct? If that invoice happens to have your name and it is borne by ABC on your behalf, you might run a risk of TDS being deducted in terms of that OPE expenditure also. It is highly debatable, but a safeguard or a precaution in place is that please ensure that whenever any kind of expense is incurred, the invoicing is done in an accurate manner. And I think this is also somewhere the guidance in 194J, if I'm correct. Right? Yeah, but they have gone beyond and mentioned it as a part in the FAQs that are there. Some expenses might just come out later. Next is dealer conferences. Again, this is settled very thoroughly by the guidance that we have. So if there is any leisure component here which is going beyond the business element or business use, in that case 194R might come into picture for so much proportion of the expenditure which attributes to leisure or other part of it, correct? What about advertising on websites? I'm going to get into a lot of debate on this one also, I have a feeling here. So advertising on websites is and I don't have an answer to this, like I don't have an answer to many of the points here, it's just in a constant state of evolution which we try to brainstorm. Now all of us are aware about websites such as 99 Acres or No Brokerhood or something like that, okay. Now typically the websites operate in a manner that for a limited period you are allowed to advertise or display your property for free. Like for 7 days, 10 days, you can just put up your property with the rental or the sale requirement. And after that, they'll give you some certain schemes, okay, 6 mahine tak this is the price, so on and so forth. Now, what happens is, what if I don't go and convert into a customer for their website? Let's say I'm a real estate developer. Okay, only then this section is going to hit me because it has to be in the course of my business. Right? I'm a real estate developer. I have some properties in Ville Parle which I want to sell, and I have advertised it on a 99 acres website. Correct? Now they tell me 14 days tak your listing will be free. We will push your listing. Everybody who tries to search this configuration in this area will be able to see your property. After 14 days, if you want your property listing to come in the first 50 searches, you will have to pay X rupees for a period of 1 year. होता होगा ना, ऐसा ही स्कीम रहता है उनका. Now I advertise it for free in the first 14 days, and there are two possibilities. One is I convert into their customer and I buy one of their plans. Correct? If I buy one of their plans, in my mind 194R doesn't come into picture because nobody is going to give you something for free. They will recover that 14-day listing cost in their subsequent charges. What if I don't convert into a customer and I avail the 14-day free listing period? Is it a benefit available to me? बहुत far-fetched है, agree, but thought तो है. Taking 194R out of where it belongs. I hope I'm clear on the transaction part of it. So is this 14-day free listing that was made available to you, is it a benefit which you received? Why? Just because there is no consideration. So later on when I actually become their customer, maybe it's a contract we enter into and we'll be then governed by 194C or some other provision. So then the 14-day benefit which I get is totally escaping, right? Because I did get a benefit of listing my property for free there. Yeah. So more or less, yes, it can be, an analogy can be drawn to the fact that when you are distributing free samples or those tester products, or when those doctors get some medicines which they distribute to some patients for free, this is something like that in an intangible way. So a favorable view is that this should not run the course of 194R, but no, 14-day free is given to me. I am displaying my property there, which others can see. But I am the recipient of benefit, right? I may not end up being a customer, like in this case I didn't. So I am a prospective customer. I may or may not convert into one, but for that 14-day period, I am using their services without paying anything. So yeah, the advertising or marketing dynamics holds good here to an extent, but that is still not like a confirmed answer I have on hand, yes.
Let us assume that section 194R was not in place. That this practice was on that Ogre Reality is doing its advertisement of projects on 99acre website. This all was happening even before the introduction of 194R. So the question then, the follow-up should be whether Ogre Reality Limited, say for example, was booking it as an expenditure, advertisement expenditure in books or not. If yes, then it would be hit by 194C because there is a specific section to that.
But Oberoi Realty is the person who advertised on 99 acres, but typically they did not incur any expenditure, right?
No, but if we apply the accounting principle, even the without consideration transactions are to be recorded in the book.
This would be like a notional income, more to say. I mean, it's like a saving in expenditure, which is like a notional income. So had 194R not been into picture, I would play the devil's advocate and I would say this is your saving in expenditure and therefore this is your notional income.
That's what I'm saying. So every notional income cannot be benefit of opposite.
Sorry? I fully support that, ma'am, but the guidelines and the FAQs themselves have gone beyond the intent of the introduction of the section here. And I get that point, yes. I mean, things would be different. Anyways, let us.
Even in case of right issue, which you said, see, practically right issue, you need to pay money as a shareholder to get shares. So there is no benefit proposition attached.
But you have to pay part of it, right? Rights issue is like not the whole price, no? Why not? So if
What is the benefit attached or what is the proposition that company is giving to the shareholder? Nothing.
the reduction in the value at which you can get that share possibly.
No, but then there is adjustment in the resources and the results of the company where the earnings are also getting.
From a shareholder perspective, I end up receiving it for a benefit, right?
So that's what I'm saying. But this benefit is not a benefit or a proposition without consideration. No?
So that way, if we were to say every benefit or perquisite is going to,
No, but then in your case, say suppose tomorrow you go to DMart, being a Monday, and you buy something there's a discount. MRP is 10 rupees, you're buying it at 8 rupees, you will say 2 rupees, you want benefit proposition.
so that has been specifically excluded by way of the FAQ, right? Had that exclusion not been there, I as in the tax administration would go and put 194R on that as well. So what point you're trying to make is perhaps it's a uniform value to everybody. That is why there is no special treatment that the shareholder gets. But there are issues which come like this, and we have to give the answer without saying a yes or a no. Yes.
Would be that renunciation of the right to the benefit or a proposition, that is something else. But if I am subscribing to
That would not be a part of 4D, right? Then.
that's not the case. And same goes with the bonus.
One second, sir. Yeah.
And same analogy goes
No, for bonus, I would like to differ. Bonus, there is a clear-cut benefit because of your original shareholding. You ended up receiving it.
no, but if you refer to, I don't remember citation, when section 56273 was in place and section 56210 was in place, there are a couple of judgments where bonus was getting triggered by department under both of this or any of this. And then there are judgments which says it's not attracted into that, because what are we doing is we are giving bonus to existing shareholders. Shares are being given free of cost to the existing shareholder. There is no cost attached to it. But at the same point of time, your capital base is getting.
So tomorrow when the shareholder sells these shares, right, he is going to get money for that also even though there was no cost he incurred, right? So there is an increase in his value, right? So that time it will be taxable, yes, as a part of a capital gains transaction. Here it is, here I am not still saying 194R applies. It's just a possibility that it might come into the ambit.
Okay, we take an example in this way. Say there is a venture capital company, okay? They are SEBI registered and they are doing, they are VC company. They have invested into unlisted company. And now say that unlisted company is declaring bonus. So they are getting this bonus shares. As we all know, bonus is free of cost. For the time being, forget that section 194R is in statute book. The question would be whether section 194Q would be applicable to VC company or not.
Because, yeah, there I have when you come to 194Q, the definition of goods has not been defined for that section. So, no, I'll tell you, listed shares have been excluded by way of a circular.
But I am giving him an example, say a private limited company, a startup company where they have invested and now there is a bonus issue. Then what you will do? Then in that case, the VC company has to be hit by section 194Q.
But in this case, there is no consideration payout, right? How will you meet the requirements for 194Q?
So there is no consideration
But there is a benefit, no? I in 194R aims to tax the benefit. Okay. He's saying if it is a bonus issue and there is a possibility of attracting 194Q, I said it won't be because there is no consideration in place. So he's saying why don't you apply the same in case of 194R where also there is no consideration in place, right? Did I sum it up properly? So I'm trying, yeah, we will. So let's agree to disagree here. There are a plethora of open issues with no solutions. So you wanted to say something on this? Yes. Agreed, sir. I feel you completely. But because of the guidelines and the FAQs and the overall effect of 194R, it has naturally gone beyond what its intention was. And it's being challenged at various levels as well, specifically the guidelines. But this is just more like a intellectual brainstorm. That's the premise of 194R, yes, yes. But tell me one thing, would the tax administration in that case not hold you as SSE in default for, let's say you're an airline company or a bank or whatever, an insurance company, you have to build your defense against not being covered by 194R here, right? So this is building our defense only, this entire process. This is not far-fetched. These are real use cases that have come to us. I am not imagining things. We have people from airline industry. We have people from websites like, what is this, No Brokerhood and, random other things, Make My Trip, this, that, so many transactions. And their only fear is because when you are in the payers or the deductors' shoes, the only intention is being conservative is what takes front there, and in that they end up losing on the business side of things. So that is why.
If they start deducting tax, then naturally their business will be down.
But if they don't, then they run the risk.
It will be litigation, it will reach Supreme Court, and then there will
that is the whole point of it. Anyways, so yeah, this is there. Now I have a case study which is somewhere here. It's a very simple one basically. So this is, again, any use of names are just random, okay? There's a, Fast Track is a company which is engaged in electronic goods and gadgets manufacturing. It engages social media influencers to aid in advertising and marketing some of its products, right? So let's say they hire a Rajiv Makhni or a Virat Kohli to do some talking about their watch and things. Now, there are two aspects here. One, these products which are given to the influencers who will showcase it on Instagram and YouTube and LinkedIn and everywhere, they are retained by the influencers, right? And all are costing in a couple of lakhs, okay? So let's say the monetary thresholds are met. Now, in this case here, when the influencers are retaining these products, would they be liable or covered by 194R? Yes? Everybody says yes here, right? Okay.
I'll tell you why. We are privy to this.
Acha, has this discussion taken place?
The earlier session, he's saying as long as you don't return, moment you return, you are not.
Correct.
If you don't return, you are.
Correct.
I'm using that.
Got it. So I will just build on this with one small one small example, I'm sorry. Suppose this Virat Kohli or whoever is onboarded as me as an influencer, but I don't approach him directly. Okay, now I know someone had raised a doubt. That theory will come into picture. Let's say I'm Fast Track. There is a ad agency, say O&M in between, and O&M has like 10 sports person and actors and everybody on their contract list. Now, I approach O&M for building a publicity and marketing strategy for my products. Right? I tell them I need 5 different influencers on 5 different platforms. These are the products they have to show, and these are the good things they have to talk about my products. I give these products to O&M. I am not responsible whether a Virat Kohli is coming in or a Anushka Sharma is coming in. I tell them these are products worth 50 lakhs I am giving you. 5 influencers, 5 platforms, 6 months. Let me see how my sales are affected. And I pay O&M. I believe me and O&M would be under a 194C kind of a contract, considering it's advertising, right? And I give these products to them free of cost. I believe these products would be outside of 194C. Whatever I am paying them for my advertising, over and above that I gave them these products. No, because I am writing it off in my P&L, advertising ka kharcha bol ke, right? Now these 50 lakh worth of products are available with O&M. This transaction, whether privy to 194R or 194C. Kyun? What I paid them never included or factored in the cost of these goods. I paid them 1 CR and uske upar I gave them 50 lakhs ka goods which I wrote off in my books. I don't know, I'm not so sure, because 194C I would say that O&M is responsible for publicity of my products in the manner we have agreed using the products I give them. Now going one step further. No, allow me, please. I will just put one more picture perspective here. O&M hands over these free products to the 5 different influencers. 5 are given to this guy, that guy, everybody, correct? Those people are going to retain those goods after they are done with their influencing. Who does 194R for whom in this case? O&M does 194R. And what did I charge O&M for the products that I gave them? Suppose my payment didn't factor anything for the products. It was purely for their services. One minute. Sir, even if it is a free sample, right? If you look at the guidance clearly, it is very specific that, goods which are negligible. If you give like a high-end instrument to a doctor, they have very well covered it under 194R. Taking the same sentiment further, if I give like a 15 lakh gadget to somebody, how can that be a free sample? It's used for advertising. Agreed, promotional, उसका पैसा मैंने दे दिया 194C में. So in this case, O&M has to show it as income. Then am I not supposed to do 194R?
I'll tell you what will happen. O&M will show it as income, and O&M will give it to these people.
And they will do 194R. Yeah. So that is eventually the answer. But then this is how it builds up. There is no one singular response here. There is no confusion, but a lot of things depends upon how my contract with O&M is worded, for one. And secondly, what is O&M's arrangement with their influencers?
The fine print can always create a problem for everybody.
But what I'm trying to bring to notice here is the same set of goods can possibly bring out a 194R trigger in 2 different transactions. We cannot deny that. Oh, one second, one at a time. I can't hear any of you then. Yeah, yes, please continue. but that O&M would say, I don't want your products, you take it back, pay me the money. So here in essence, assuming that the contract doesn't factor it, it goes over and above my 194C. In that case, 194R could be a possibility. I'm not saying it is. I'm saying it could.
Not for you, but for O&M.
All right. Okay. And that is the third point which I had to bring up. Okay. So the view would possibly be that O&M does 194R when they pass on the products to their influencers.
No, it depends. No, it can be, as you also said, it can be the company as well. It all depends on the wordings of the contract.
But assuming I pay them only for the service.
Then it will be O&M because somewhere this 194R has to fall.
Exactly. And in my mind, on a conservative footing, I repeat, I will also do 194R when I hand over this 50 lakhs to O&M, and it will be O&M's call to do 194R when they hand it over further to the influencers. This is a safer way out. It might not be a practical way out, but it's a...
Subject to TDS, the question is what section?
Sorry?
Subject to TDS, that you agree.
Yeah, subject to TDS.
The question is
Either 194C between me and O&M or 194R. But between O&M and influencers, it ought to be 194R. That is how it looks logically. All right. Anybody wanted to ask anything? No? We can go ahead. All right. Okay, so last use case I have is for 194O. Was that discussed earlier? No. So e-commerce, just allow me a sip of water, please. So this was triggered by the development of e-commerce business 194O, which we have. I'm sure most of us are aware about the provisions. E-commerce participant, e-commerce operator. There is a liability on the e-commerce operator to make TDS at the rate of 1% on the gross amount of sale or service or both. Now, if the e-commerce participant is an individual or an HUF, and if the gross amount of sale or service is not exceeding 5 lakhs and PAN and Aadhaar has been furnished, then there is no requirement to do TDS under this section. Again, if a transaction is covered under this section specifically, because it's conducted through a digital marketplace or an e-commerce platform, then no other section can be triggered in respect of that transaction. This is to possibly avoid an overlap between O and Q. There might be instances where there could be some, right? Now, what is an electronic commerce? It is the supply of goods or services or both over a digital or electronic network. E-commerce operator is someone who manages the digital marketplace. Participant has to be a resident selling its goods or services on the digital platform. And services also you could be selling, which is defined as, same as per 194J explanation, right? Now, Amazon, Airbnb, Zomato, Swiggy, Make My Trip are all examples of your e-commerce operators. You could also have Zomato, Swiggy, right? Everywhere where it is possible to list your business or service online. Now, there are no thresholds which are specified under this section except the exception given to individual or HUF participants. So, whatever be the transaction value, the e-commerce operator is under an obligation to make 1% TDS. The CBDT came out with some guidelines which were thoda helpful, saying that payment gateway, if it does TDS, e-commerce operator ko nahi karna hai, kind of mitigating the dual effect wherever it was possible. And in respect of insurance agents and aggregators, so if the insurance agent or aggregator is not having any involvement in transaction between the insurance company and buyer of the policy, then he is not under an obligation to deduct TDS. So if it is like a policy bazaar, for example, let us assume that policy bazaar is only for listing by insurance companies, wherein the individuals go and buy insurance, and then everything that has to be transacted is between the company and the buyer of the insurance. Policy bazaar has no role to play. Then it is not under an obligation to deduct TDS. But if you have a more involved aggregator, like I think ACO perhaps, which helps with handling of claims, or which helps with some other facets related to servicing after the insurance is bought. So in that case, there is an involvement of the insurance company, insurance aggregator in between. So he would be under the obligation to make TDS as well when the insurance is bought from its platform. That is how I understand this. Now, who does what is market specific knowledge? I don't have that, but I'm just giving you comparatives that, let's say, Policy Bazaar is not involved in settling of claims or any services once the insurance is being purchased. Then it has no role to play, no TDS to be done by Policy Bazaar. Let's say ACO Insurance has a role to play in terms of claim settlement or some other kind of support needed on arising of a claim or anything else, then they would be under an obligation to make TDS, is how the guidelines spell out. Now this is a case study, the last one for the day. All names again are hypothetical, all right. There is a entity called Make My Trip, which is a non-resident which owns and manages an electronic platform wherein all the airlines and hotels list their stays and ticket prices, right? Based on the search criteria by users of the portal, the platform gives out different options and prices, etc. Now, Make My Trip is going to charge some fee from, let's say, Air India or Taj or Lemon Tree or those kind of entities which are listed on it. So the idea here is, for every sale which is effected through Make My Trip portal for the e-commerce participant, now the rate is 0.1%. Okay, 0.1% of the gross sales or receipts or whatever it is, TDS has to be made by Make My Trip. Right? However, if there is any advertising or hosting of services in particular for which there is a consideration which is exchanged between the participant and the e-commerce operator, that is not subjected to this TDS. It is only the sale factor which comes in. Correct? Now in this case, can Make My Trip be called as a e-commerce operator? Usually yes, because it's like a marketplace listing. People are listing their services there, and because it is an e-commerce operator in this case, it will be liable to deduct TDS under 194(o). Now just taking this example to a Zomato kind of a situation, let us say a cloud kitchen is registered on Zomato, which is run by an individual, right, in some suburbs of Mumbai, and they are individuals, the PAN is furnished, and the sales that take place from use of that platform are below 5 lakhs. In that case, no TDS is to be made by Zomato in this case, right? Now, while this sounds simple, at least in hearing, but there might be some difficulties. Again, these are difficulties which I foresee. So suppose there are instances where at sometimes you may pay directly to the hotel owner. Like if I order from, say, Copper Chimney via Zomato, sometimes the payment happens that I pay to the hotel. It happens usually on Amazon and Myntra, not so much on the food delivery things. So sometimes the payment goes to the vendor, sometimes the payment goes to the e-commerce operator in between. Now, as per what the section is, irrespective that the payment has gone to the vendor directly, the e-commerce operator has to reconcile all the sales which have taken place by virtue of its involvement, and uska 0.1% has to be made. So there will be a two-way reconciliation between the vendor and the e-commerce operator, that how much sales revenue was collected by you for sales effected through the platform, and how much sales revenue was collected by the operator for the participant behalf. वो reconciliation अलग है. But even if the payment is made to the vendor directly, it will be a part of the base calculation for TDS by the e-commerce operator. That seems to be the idea. Now this would be a very complex understanding and hisab kitab between the vendor and the e-commerce participant, because a lot of times when you buy through portals like Amazon or Myntra, there are times where the payment goes to the vendor. Okay, so that is one thing. Secondly, quick commerce इसमें कैसे fit बैठता है? I am trying to imagine, because quick commerce is like a postman. Okay, they are not listing anything, whether they call it. This is, see, again something which I am raising of my own thought process. While the provisions are in place for e-commerce operators, I have discussed them here, but something like a Zepto or a Blinkit, right? It's like a marketplace. It's like an aggregator, but it's like a postman, right? It's just collecting my order from everywhere and getting different vendors to pack it and give it to me, for which they are charging some convenience charge from me. So उनको ये आता है कि नहीं, I don't know. I mean, it's हाँ, वो how मेरे दिमाग में नहीं बैठता है. How नहीं बैठता. So because they are not listing anything, they are just helping us buy things online, right? But it doesn't disclose to me मैं कहाँ से buy कर रही हूँ. Like for example, if I buy from Amazon, it will tell me that you're buying from XYZ, who is a Amazon verified vendor. ठीक है. अब Zepto उसके गोडाउन में भी कितना कुछ भर के रखता है ना. अभी बीच में एक वीडियो वायरल हुआ था, wherein they showed कि in what sorry state their godowns are. So how would this work in that? So they are stocking things up, right? It's like they are acting as a agent that I have certain things at my disposal ready, क्योंकि ब्रेड का डिमांड सबसे ज़्यादा है. तो संडे इवनिंग ब्रेड का डिमांड सबसे ज़्यादा है, तो आई स्टैक अप लाइक 500 पैकेट्स एट माई गोडाउन. तो वो कहाँ से ले रहे हैं फिर वो कौन है? हाँ, we never know the vendors for one, and for two, they themselves also stock up things, which doesn't happen with Amazon or.
So it happens with Amazon, Flipkart as well. They also have their, storehouses. So it shows the vendor name.
इधर मुझे my payment goes to Zepto, right? My payment doesn't go to the किराना store जिससे मैं ले रही हूँ. मुझे पता भी नहीं है वो कहाँ से ला रहा है. सो क्विक कॉमर्स इसमें कैसे फैक्टर होगा ना, वो मैं सोच नहीं पाती हूँ, बिकॉज ई कॉमर्स के लिए मेरा दिमाग सेटल हो चुका है. Which is what you're trying to say when I meant that they are stocking it, right? हाँ. So but then they are ultimately delivering to me and I am B2C, right? So they are like a facilitator. They're like a, so similar goes for this Borzo and Porter kind of things, वो कैसे कहाँ factor होते हैं वो लोग? They are like they are the Olas of delivery, I would say, है ना?
Even this business models like Zepto, they are e-commerce. It's just that because they deliver it very quickly, that's why we call them quick commerce. It's a part of the.
Okay, but tell me one thing. One thing is sure, that they have a e-commerce platform, which is their portal or app or website. But who are their participants? I just know that इस पे टाटा संपन्न मूंग दाल 1 kg मिलने वाला है. Who is selling it? I never know.
They might not be disclosing it.
So I think थोड़ा सा उसमें more refinement की ज़रूरत है in terms of the TDS provisions, कि whether quick commerce is a part of this, yes, no, if no, what amounts. I think they themselves might be grappling with answers right now.
Even Zepto has started own kitchen, cloud kitchen also.
Zepto Cafe and all, yeah. So it's a very, that's what I said, it's a very evolving, every 6 months something new happens.
It's hard to order something now.
All right. I think with that I will end my presentation. If there are any questions or anything, I'm happy to take them. And before that, I would thank you all to be a very lovely and patient audience. I will always remember my first offline lecture at this platform. Thank you so much.